Last week, the S&P had the best and the worst day in the market in 2024, and we can see some very mixed performances right across the board. However, when we zoom in over the last month into the semiconductor space, Nvidia as well as its competitors have had a very poor performance. In fact, Nvidia alone down around 18%. Now, if we take a look at one of the most popular ETFs in the semiconductor space, it was also down around 20%, so we can see some mass poor performance right across the industry. Now, one of the main reasons that we do see this one performing fairly poorly, because Nvidia does make up its top holding around 20%. Now, Nvidia itself, not the greatest, as we mentioned. It is down nearly 30% from its all-time highs of $141. So today we want to understand, with them reporting their earnings over the next few weeks, is it a great opportunity to buy for some massive gains? Because if this company was to go to its all-time high, that would be a near 40% gain. Now, as we mentioned, they are reporting their earnings on the 28th of August after the market close, and we have seen historically a very strong performance when we have analyzed their earnings. Last 4 quarters, remember, they have beaten, and the next quarter, the expectation is going to be massive. Triple-digit growth, 136% on a year-on-year basis, and ultimately their forward P will come down to around 28 if they can keep hitting those very high targets, which a lot of people would argue is very reasonable for this semiconductor king. Now, a few articles have come out with the expectation of earnings, and Barclays themselves has said that big tech is due for another large catalyst if Nvidia does beat their earnings, which now seems to be the expectation right across the board. We also have Forbes talk about how Nvidia stock could pop if essentially the Q2 earnings is a blowout. Now remember, if it does beat its current all-time high, that is a near 40% gain. Now, a few things that we want to discuss in today's episode as well is also understanding what are the insiders, what are the institutions doing, can we see any coherent themes? Now, the first thing to note is insider ownership. It does sit at 4.2%, but we do notice a significant amount of sales. Now, that totals to around 820 million over the last year. And when we look at it on a quarter-on-quarter basis, we note the more recent quarter, Q3, 300 million worth of sales. In fact, if you do go along the quarters, we do see pretty much every quarter an insider is selling. In fact, over the last 4 to 5 years, the only quarter was Q3 of 2022 where we didn't see anything. So understand that this is a regular occurrence, but ultimately for transparency, we do want to show you who these are. And we do note the CEO himself has been selling, and the more recent period was just last week, both on the 7th of August as well as the 5th of August. We can see that he is selling tranches of 120,000 shares at a time, and we can see each time does net him around $12 million. Now, granted, this isn't a massive portion of his total shares that he holds, and this has also been something that has been expected from his filings, but do bear in mind that we never really indicate any insider selling as a bearish signal, as insiders sell for many reasons, whether that is personal or financial. Now, we ultimately do the same thing for the institutions, where they hold around 65%, and even though we see 8 billion worth of sales over the last year, we see a mammoth 177 billion worth of buys over the last year. And we can very interestingly see that a massive buy was there in Q2, 172, with very minimal worth of selling in comparison. So we do note institutions are buying a lot more in Nvidia than they are selling. But as always, do bear in mind we need to do our own due diligence and never copy what insiders or institutions do. One thing you need to understand with these semiconductor stocks is that there is a lot of geopolitical tensions surrounding them, and therefore last month when we did see comments coming from both Biden's administration as well as Donald Trump that the shares did take a very massive hit. It wasn't just Nvidia but also the bigger names as well. So one thing we need to incorporate when we're thinking about Nvidia as a buy is that geopolitical tensions will take up some of that margin of safety that we need to consider. On the positive side, many of these semiconductors have reported, and very strongly as well, TSMC reported in July the 18th, so just a few weeks ago, where in fact they talked about an AI chip boom and how they see it continue. And in fact, one of their directors talked about the demand for generative AI, which is surging in the cloud and at the edge, which is a very strong signal to Nvidia for the investors who are hoping for a very strong blowout earnings in the next quarter. Again, ASML very strong. They talked about how the AI chip demand is continually boosting their purchases of their semiconductor tools, and their net bookings rise 24% year on year, which is one of the most key metrics that the investors do take a look at. And their CEO ushering some very similar comments to what we just heard from Taiwan Semiconductors. They currently see some strong developments in AI, driving most of the industry recovery and growth ahead of other market segments. Now look, these aren't the only two. We can also take a look at Qualcomm. They also beat earnings and revenue estimates as well. Now we're not going into each one, but if we did, we would ultimately show you that both on an EPS as well as on a revenue basis, they have beaten. So very strong signal. We're talking TSM, ASML, as well as effectively Qualcomm. We also recently had AMD as well, who also beat, and they talked about data center sales more than doubling in a year, which is a very bullish signal. In fact, when we look at this, their key point here, they sold over $1 billion of their chips during the quarter, and their data center category surged 115%. Now, why is that important in particular for Nvidia? Well, let's just take a look at their latest quarterly presentation. In particular, we're referencing the data center part, and that growth has been astronomical. In fact, from FY23 to FY24, it has more than tripled. And if we extrapolate this, because this just relates to Q1, up to 4 quarters, they're anticipating nearly 100 billion of revenue purely on the data center perspective. Now, is that something that can be achieved? Well, we just saw AMD where they've come out and said it has more than doubled year over year. Now, that doesn't necessarily mean that will happen for Nvidia, but these are some bullish signals that is very positive news for those people who are Nvidia holders. Now, unfortunately, not everything is bullish. We also have to look at the other perspective. And if you are someone who has been keeping up with all of the latest information, you will know, and one thing that I do quite like from management, whether that's Nvidia or any other management teams, is that they have a roadmap to where they see the company progressing. And not too long ago, Nvidia ran through their 2024 numbers. They talked about Blackwell GPU. They talked about 25, the Blackwell Ultra, 2026, the Rubin GPU, as well as the Rubin Ultra. Now look, that's not the bearish news. Unfortunately, over the last few days, we've had the news that there have been design flaws which have delayed Nvidia's Blackwell chips until 2025. Now remember, they were meant to be here for 2024 and this year, and the CEO himself did say that we would see them in the upcoming numbers. So a little bit of a worry whether or not that actually the growth that we were wanting to see in the EPS as well as the revenue may not be as strong as what we had expected. And in fact, we can see here it relates to the B200 chips, and they are unusually late in the production process. Now, as noted, the chips were expected to be in the customer's hands later this year. However, the delay could impact the production targets, forcing some of the shipments to be pushed back into 2025. Now, the manufacturer TSMC did uncover this reported design flaw, which affects the processor die connecting the two Blackwell GPUs on a single board. Now, granted, this may be a little bit more tech than what we can understand, but ultimately what this means that the numbers that we were expecting relating to the Blackwell may not be as high as we were hoping for, given the CEO's comments not too long ago. Now, the spin to this, whilst it is unconfirmed, is that they have been offered a liquid cooled H200 instead. Now, it doesn't necessarily mean that those customers will buy the same amount numerical value of these other chips being offered, but ultimately that may gap some of the missing revenue that we would have seen from them not buying any of the products at all, the Blackwell to be specific. Now, just to remember, with Nvidia, we have seen some very strong growth. Now, this is total revenue, not just the data center. 61 billion in FY24. Remember, if we extrapolate this will be now over 100 billion in revenue. That is nearly a double of what they produced in the full year of 2024. And one thing, if you did watch our AMD analysis, that we love about Nvidia, that not necessarily we see with AMD, is that their margins also increase. We're talking about a 34% operating margin in FY20, going to 61% in FY24, and we can already see just from the first quarter of their results of FY25, 69%. So remember, for those that are new, high quality companies have many traits, two of them being increasing their revenue, which we can see Nvidia do, but also increasing their margin. Again, something that we see not just on the operating income, because when we also look at the gross margin, we're going from 63 billion in FY20 to around 79% in the first quarter of FY25. So fantastic to note, something that we do just want to highlight and bring to your attention. The other thing that we love and very important, because it's ultimately one of the main metrics we use along with the ROIC as well as others to screen high quality companies, is growth in the free cash flow, consistent over the longer term. Now, while we don't get that consistency, what we can see is some very large numbers, 27 billion in FY24, and if we extrapolate the 15 billion, we're talking 60 billion for the full financial year, which is more than double the previous year. Now remember, this is purely based on if they can hit those numbers, and that Blackwell will be a question mark, as we just discussed. Other ways that they actually allocate their capital, they did a lot of share repurchases, which is always essentially giving excess cash to investors as you ultimately own a larger portion of the company. They had a massive dividend increase that we'll talk about, and they also have through growing their own talent as well as research and development. Now then, finally, the last thing that we want to talk about before we look at some underlying key metrics to highlight is just a few different ways that they are looking to increase their top line. One of them we're just going to talk about is the autonomous vehicles and robotics. They see this as a 300 billion market, maybe something you're more familiar with seeing around Tesla and the way that they're using robotics in the future with Optimus. And when we take a look, we can see that Elon Musk himself has been ordering Nvidia chips. And when we actually look at the detail, he has said in a tweet that he anticipates Tesla will spend around 10 billion this year in combined training and inference AI, which I do believe a lot of this will come from Nvidia, as he has already mentioned. Now, we also want to let you know that we have released our latest free weekly article. If you want access to this or any others, you can grab a copy free and straight away by clicking on the pinned comment below, where you can also grab a copy of our 35 undervalued stock spreadsheet for the month of August, where we also run through those that we hold within our own portfolio. Now, we want to run through some of the underlying metrics. Now, yes, they have an 89 very safe score in the dividend. Granted, the yield is fairly low at 0.04%. And we also mentioned earlier the very rapid growth they had to that of 150% in May, and something we believe they will continue to do with the vast amount of cash that they do currently have. Now, in the last recession, so the 07-09 Great Recession, they didn't pay a dividend, so we don't have any comparative data, but their sales were negative 35%, which was below the average of the S&P at negative 12, and they also significantly underperformed negative 78, trading the S&P negative 55. In terms of dividend growth, well, very large, as we mentioned in May, 1% over the last 5 years, as they didn't increase it for quite some time, but 7% over the last 10 years. So whilst they've only increased it for 1 year, given the fact that they have just done that in May 24, they have been paying a dividend for the last 11 years without a reduction. Now, typically on this channel, we look at dividend yield theory, not something we will look at for Nvidia, given the yield is very low and fairly trivial, but we want to draw your attention to the forward PE. Whilst it trades now at 36.5, that is substantially lower than the 5-year average of 42.3, so this is an undervaluation signal, but bear in mind we don't conclude on this model, and we'll look at the valuation shortly. We also want to point out the information technology as a sector does sit much lower, but as we will show you, it does truly deserve a premium. Whether or not 36.5 is the right number, we will come to that through our analysis. Then we want to just point out the free cash flow payout. Whilst we want to see it below 50% for semiconductors, it's incredibly low for Nvidia, which is one of the reasons, if they want to, moving forwards, they can continue to increase it at triple digits, 100%, 200%, whatever really they see fit as management team. In terms of free cash flow per share, we already covered this. Massive growth. Whilst we do see it consistently increasing over the longer term, the true growth has just come over the last few years, and it is anticipated to more than double over the next 12 months. Bear that in mind, that is more than a 100% increase, because that will be important when we look at the stock valuation. As we mentioned as well, sales growth has been very strong, especially in the more recent period, 126% and 208 on a trailing 12-month basis. And no surprises then, numerically, it has gone from 5 billion to 61 in 2024. Now, we always love it when companies do share buybacks, as we already mentioned, something that they have started to do again, but over the longer term, it has actually increased over the last 10 years, so they would have diluted your position as a shareholder, but as we have come to see with this company, the share price return has been absolutely phenomenal, so you wouldn't really care about this small dilution. We then look at the ROIC, very important return on invested capital. 10% is used because it gives us faith that management are able to effectively allocate their capital. Very strong numbers over the last 10 years, 61% in 2024 as well, looking very strong. 78 on a trailing 12-month basis makes this company incredibly attractive to potential or current investors to add again. We then also see the operating margin above 16% is what we want. That is what we get, but we also see operating efficiency increasing over the longer term. And you may think this is quite easy. They can increase their revenue, increase margins, but just take a look at other companies when we do look at them on this channel. For example, AMD, yes, they continue to increase their revenue, but they are sacrificing their margin, which tells us it isn't as a high quality company as Nvidia, although there is a lot more analysis that goes behind that reasoning. We can also see free cash flow, pretty much a free cash flow machine, higher than 5% every single year, 45 in 24, 50 on a trailing 12-month basis, some very strong metrics for this semiconductor king. Ultimately, the net debt to EBITDA, what it shows us is the strength of the balance sheet. We want to see below 1.5, and these are the number of years it would take the company to pay off all of their debt net of cash on hand, telling us it wouldn't even take Nvidia one day. Absolutely phenomenal, and we're going to show you that through our analysis shortly. So the income statement, we've already told you their top line revenue has seen incredible growth over the last 10 years, as we can see as well graphically, although we can see a large growth spurt just over the last year. But we want to point out the bottom line, tell you the story that we see here, and in fact it has increased astronomical. In 2015, if you were looking at this company's reports, they produced 631 million in net income. Fast forward 10 years, just under 30 billion. That is absolutely insane. And we can see that astronomical growth graphically on here. January 2024, a massive increase from the previous year. We then want to take a look at the balance sheet. As we said, very strong, but we always show you through a comparative total cash versus total debt. And we can see here 4.6 billion of cash in short-term investments, 31.4 in their latest quarterly report. This has also been increasing near enough in line with their revenue. That is a large number to have, but as always, in isolation, it ultimately doesn't tell us anything, which is why we compare it to their total debt numerically and directionally, and we can see it's gone from around 1.4 billion in 2015 to around 11 billion. So granted, their total debt has been increasing at a very rapid rate and does sit at a very large number. It is much lower than their total cash, and hence that is why we said if they wanted to, they could pay off all of their debt net of cash on hand in one day. Then before our valuation, we're going to run through some gradings. The first one is the valuation. Now this is here purely to show you that the valuation of Nvidia compared to the sector median is much higher, hence why they get an F grading. For example, the PE on a non-GAAP forward basis, 38.5, sector median at 23. Right now, if you are buying Nvidia, you are paying a 70% premium in comparison to the sector. We'll show you shortly why that doesn't seem to be as bad as it sounds, but ultimately, whichever valuation method you look at, Nvidia as a whole does trade at a very lofty premium. Now, the next grading we're looking at is the growth grade, where they get an A+. Now, when we take a look at this, what we can see, year on year, 208% growth, sector median at 3.42. We have one of our first reasons at why it's justified it should trade at a premium. Forward-looking, 83%, sector as a whole, 7, so another reason we can see even the forward-looking data is significantly better. And when we get to the earnings per share, 37% expected year on year over the next 3 to 5 years, with the sector as a whole much lower at 14.5. So in terms of growth, it completely blows the sector right off the mark. And then when we get to the profitability, again, we can already see, spoiler alert, A+, so very strong. Gross profit margin, 75%, sector median at 50%. Bottom line, 53.4%. Again, net income so much better than the sector of 4. And the main thing we really want to point out here is, look at this cash from operations, 41 billion versus the sector median of 100 million. That is significantly higher, and one of the reasons why we can see that justification and why it does warrant that extra premium. Now, a quick wrap up of this part of the analysis. Well, Wall Street continuing with their strong buy, a double hold from Quant and Seeking Alpha. And no surprises then, an F on valuation, A+ on growth, and A+ on profitability. Now the final thing before we jump into the valuation is just showing you their return against others in the space. We have TSMC that we discussed earlier. We have Broadcom, AMD, Qualcomm, and TXN. Pretty much the majority of these we went through. We talked about their earnings in their more recent quarter was very strong, and that is one of the reasons why we do expect Nvidia to have fairly decent earnings as well. Now look, over the last year, Nvidia still up even after a drawdown of around 30% from their all-time highs, up 146% this year, completely outperforming all of the other competitors. Over the last 5 years, no surprises, and over the last 10 years, again, significant outperformance. Now look, it is important to always mention that past performance doesn't mean that in the future they're going to perform as strongly, so do bear that in mind and do have a strong investment thesis before executing on any stock. Now let's get into the valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now the intrinsic value today of $140, again, it is unchanged from previous episodes, and we're going to say that Wall Street have upgraded their valuation to $144. They see 38% upside. Now how we got to our valuation, we ran it through the DCF model. We have the free cash flow year on year, and that gives a 5-year growth rate of 135%, a 10-year growth rate of 94%, and over the next year, as we just mentioned, they're anticipating to increase their free cash flow by around 120%. So we have a growth rate here of 30%. Now how we got to this, we have a low, medium and high, 25, 30, 35, which we do believe to in fact be lower than the industry expectation. For example, Bloomberg did release a report last year where they believe that the AI market is anticipated to grow around 42% year on year over the next 10 years. So as we said, with our median rate of 30% that we've used, we get the discount rate to give us the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding to give us ultimately that intrinsic value of $140, showing upside right now of 33%. Now remember, these numbers are subjective. You can grab a copy by clicking on the pinned comment below and running through your own numbers, whether it's for Nvidia, you want to try different percentages, or any other companies on your watch list or in your portfolio. Now for full transparency, we will use other rates just to show you. So for example, 25% would give around $100, which is around 4% downside. You could argue then at the current price around 101 to 105, you are baking in around 25% growth to the free cash flow. For those that believe that is way too conservative, at 35%, that is around 83% upside, nearly a $200 mark, nearly giving you a double on the current trading price. As we said though, we will use the 30% into the final slide, and what we like to do is use a margin of safety. As always on this channel, we use 10% and we execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for essentially Nvidia today, a buy up to $126, then we keep going till it's near the current trading price. And what we can see in today's episode, you are pretty much, if you are buying Nvidia now, getting a bang on 25% margin of safety. Remember, that is based on the estimates and judgments that we have just gone through. As always though, do let us know your thoughts below. Do you believe the rates are appropriate? Do you believe 25% margin of safety is sufficient? Are you happy with the upside from Wall Street? Maybe you want to see a little bit more before executing. And ultimately, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to click on the pinned comment below so you can sign up to the weekly newsletter. And if you want to join us in the Patreon below, we talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.